Thanks everyone for tuning in. In this episode, we'll be talking about the first and most common way a new trader loses money in markets. It's what most beginners are introduced to technical analysis through, which is the classical technical analysis patterns of flags, triangles, pennants, etc., etc. When introduced to analysis through the lens of looking for a pattern made by connecting lines on the chart, it becomes the standard mode of operation for a trader. As soon as he looks at a chart, his mind starts connecting lows and highs, looking for those patterns, which in reality just confirms what he wants to see, his own confirmation bias. So unfortunately, a lot of deprogramming has to be put in place to be able to view the market for the continuum that it actually is. So we'll be going through 4 concepts as usual per video. The first is viewing the aforementioned patterns in isolation versus in conjugation with market structure. Then we'll compare models versus patterns, which will be comparing quantitative analysis versus qualitative analysis. Then we'll look at how to measure relative strength using the aforementioned models, aka relative strength the quantitative way. Lastly, we'll look and talk about why quantitative analysis is the easiest path to consistent profitability in trading. So a great example of the shortcomings of trading classical patterns in isolation is this structure on Bitcoin in September of 23. A very clear head and shoulder pattern. Classically bearish, with the expectation at exactly this point is the formation of a right shoulder. But if we look at this pattern from a different lens, namely in conjugation with market structure, we would see something like this. Price has broken through the top of the last pullback of the downtrend right here. This point has been broken through, giving us a first bullish signal. Market then pulled back, giving us a second point to break through, the top of that pullback right here. Second structure break, a second bullish signal is put in place, but still not enough to signal a trend reversal and the ending of the bear market. Then a third pullback is put in place, this pullback right here, giving us the top of that pullback, which, as we talked about in previous videos, is a trend origin point. We've talked about how a successful break of the third structure break, aka the trend origin point, signals a trend reversal and the start of a new trend. Here we see how the market successfully broke through the trend origin point, supported on it several times, and then proceeded into the bull market. Both you and a pattern trader would have been looking at the same chart, but through a different lens. As trend followers, we look at signs of a new trend forming and the old one ending. This starts with looking at the tops of the most recent pullback in a trend. If that breaks, that's our first signal. But it's not merely enough for a new trend to start. We need 3 confirmed signals, also known as a trend origin point. You wait for a pullback after the first structure break, then a subsequent break of the top of that pullback, second structure break. If another pullback is put in place, after that happens, the top of that pullback gives us a potential trend origin point. But it's still a potential one because it hasn't successfully been broken through yet. Not just broken through, but successfully broken through. If the trend origin point is broken through successfully, namely break and hold, or break, liquidate, and then reclaim, it's also another form of a successful break, then probabilistically speaking, you have a very high chance of a new trend starting after 3 subsequent structure breaks of the old trend. So if you put the head and shoulder pattern we see in the context of this market structure, we would know it's merely a bear trap. So when looking to enter a trend, we ideally want a pullback to enter on. But what is a pullback really? How do we define it? How do we know it's a pullback in a predictable, consistent manner? Pattern traders will tell you should look for flags, wedges, or pennants. Pullback patterns to indicate a pullback. They're not entirely wrong, but they will be late into entering that pullback because those patterns only become confirmed once price has broken through them. They also don't offer an exact level with potential to put a tight stop loss on. The quantitative analysis solution for that is models using numbers. In the example above, we're looking at the same trend that we saw earlier after it has started. Had you missed the first trend origin point below, you'll be waiting for a pullback against the main trend. The quantitative way to measure a pullback is a number of breaks against the main trend. But first, we want to know where we are in the main trend. We want to measure how many structure breaks this trend has had in one direction. In this case, Bitcoin had 7 subsequent breaks in one direction to the long side without any structural pullbacks, also known as breaks of structure in the opposite direction to the main trend. Generally speaking, you want to look for structural pullbacks around the 6 to 9 breaks region of the main trend. After 7 bullish breaks on Bitcoin here, we got our first bearish break right here. Why is this our first bearish break? Because this is the last bullish break, and the last bullish break has come from here. So if this is broken, this is the bottom of the last pullback. So if this is broken, it will give us a first counter trend break. Can the market put in one break in the opposite direction and then reverse? Yes, that would be a 1 to 7 model. It can happen, but it's less probable. It's less probable when you've had so many breaks as 7 in one direction. One counter trend breaks usually reverse in smaller trends, like a 1 to 3 model. In a 7 break trend, you usually see further breaks. But as we've seen earlier, 3 breaks against the main trend give us a potential trend origin point. But if you've noticed, whenever we describe trend origin points, we've said potential until it's successfully broken through. So in this case, Bitcoin have put a potential trend origin point right here, but price did not break through it. When trend origin points fail, either by an unsuccessful break or by not breaking them at all, they become an excellent entry point for the original trend to continue. We see it in the above example. 3 breaks against the main trend of the 7 breaks, giving us a 3 to 7 model. Trend origin point right here put in place, but price did put it in place and then reversed from it immediately and start going long. So when trend origin points fail, they give us the exact bottom of the pullback, which can provide a very precise entry into the main trend. So in this slide, I want to get into the concept of relative strength using simple quantitative methods. I took an example from the most recent Bitcoin bear market. Looking at the beginning of the downtrend, here we see 5 consecutive structure breaks to the downside, giving us a successful break of a trend origin point, also known as the third structure break. After that, during this period right here, we got two counter trend breaks, one right here and a second one right here. At this point right here, there were lots of traders being bullish again, calling new all-time highs in a month or so. But if we count the number of breaks in either direction, we'll get 2 breaks to the long side versus 5 breaks to the short side, which will give us a 2 to 5 relative strength to the bear side. At the same time, this point here did put in a potential new trend origin point that was not broken through. So in the same manner as the last example we saw, just merely reversed, we got a trend origin point that was put in place, but price didn't even test it or didn't even try to break through it, which gave us the exact top of the pullback. This is a great example here of how these trend origin points and relative strength models can give you very precise entries into established trends. So all these examples we saw now have one thing in common. All the analysis is based on numbers, aka quantitatively rather than qualitatively, which is what the trader evaluates the pattern to look like or give a feeling of a certain direction. This is not to say some traders cannot be profitable using qualitative analysis. Those traders have to have many long years of experience, but yet again, qualitative analysis varies a lot based on the psychology of that trader in that day, compared to quantitative methods, which is constant and always the same, irrelevant to how the trader feels that day or how his trading has been. So this tells us that through these very simple methods, we can put in a very consistent, profitable system. So thanks everyone for tuning in. This is the 4th video on this channel in this series of quantitative analysis in day trading. So do subscribe for more videos like this. Thank you.